Today is Monday, December 18th, and this is the ADM Investor Services Monday Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Steve Freed, Vice President of Grain Research at ADM Investor Services, and Alan Bush, ADMIS's Senior Financial Economist. Steve, we saw a private estimate of final U.S. 2017 crop production and 2018 acres. What did they say, and was there an impact on the market?
Well, first of all, they raised the corn yield a bushel per acre, and so that should be negative if on January 12th they do that. We've actually seen some private people go out and canvass and survey some of the seed companies, and they actually, instead of a 176 yield, came up with a 181 yield on this year's crop, which would be pretty negative to corn prices. They raised a little bit the bean yield, not a big thing, and so as far as acres next year, they talked about farmers dropping corn acres 1 million. They talked about farmers adding 1 million to bean acres from this year, and maybe taking 1 million off of winter wheat acres. So at the end of the day, I don't think it's a big change depending upon the weather, and there are some talk that farmers might even switch more corn acres to beans because of the positive bean-corn ratio.
Anything new on the fund positions and your current technical analysis?
Well, we were surprised a little bit that the funds right now are shorter corn and wheat than what we thought. So they're adding to those corn and wheat positions on the short side. You know, you would kind of look at prices at contract lows and think that enough's enough, but without any big increase in demand or any weather problems, those prices will probably stay here or maybe even leak a little bit lower. You know, we have carries now in the marketplace, and so as March contracts get close to expiration, they probably will drop down to where the December contract went off the board. We found that they were bigger meal longs than what we anticipated, and last week China came in and priced some beans, so they continue to be long the oilseed complex and short the grains. And technically speaking, we're at contact lows in corn and wheat, and beans are dropped below the 50% retracement of the entire move last year, so right now the signals are negative.
You mentioned the next report. I think the next report is January 12th. What are your and the street's expectations for this report, and how might that impact the market?
We'll be in Florida when the report comes out, so we're excited about that, but I think the market's afraid of a bearish report because you could have a bigger corn crop, you could have record December 1 corn and bean stocks. The USDA could actually lower corn, bean, and wheat U.S. export numbers and raise the Brazilian soybean crops. All those things could be negative to prices.
Finally, Steve, any world weather situations we should be following right now?
I think two things. Argentina continues to miss some of the rains that they are forecasted for. That's really the only hot spot. But the big thing about 2018 is La Nina. If it continues into February, you can see a little bit drier than normal weather across the southern part of the United States and maybe wet weather across the northern part. So there's a little bit of concern about the winter wheat crop as we get into the spring.
Alan, let's talk financials. As expected, we saw a quarter-point hike in the Fed funds rate last week. The Federal Reserve officials have predicted 3 more quarter-point increases in 2018 and 2 in each 2019 and 2020. Do these predictions appear to be a little too hawkish?
I think they are. Hawkish implies that the Fed is likely to raise rates at a faster rate than what some analysts are looking for. So yes, I think these opinions and predictions are a little bit too hawkish. Don't forget that interest rates in Europe are still in some places negative. So my estimate is that there could only be 2 rate increases next year, not 3.
You use the terms hawkish, and the other term you use when you're talking about the Fed is dovish. Can you explain what dovish means to our viewers?
Sure. They're basically opposites. Hawkish implies a higher interest rate outlook or a higher interest rate opinion, while a Fed official that is dovish implies that he or she is anticipating that interest rates will remain relatively low.
Let's talk a little bit about the gold market, Alan. Gold futures have been pressured by a slower rate of inflation, along with talk of a hawkish Federal Reserve. What is your outlook for gold futures now?
Well, the gold market is actually looking a lot better. It has broken out above a steep downtrend line. And if we do get tax reform, that would imply a stronger U.S. economy. A better economy implies more inflation, and higher inflation suggests higher gold prices.
Finally, Alan, again this morning, the Dow Jones, the S&P 500, and NASDAQ futures advanced to new historical highs, boosted by optimism over a tax cut agreement. Any changes on your bullish sentiments for the stock market?
Absolutely not. Nothing has changed at all. I continue to believe that as interest rates are as low as they are globally, that will sustain the bull market through the balance of this year and well into next year. So any breaks should be used as a buying opportunity. There is a lot left to the upside, both price-wise and time-wise, in this bull market in stock indices.
Thank you, guys. I wish you both a happy holidays, and to all our viewers a happy holidays. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.